Advisors.
All right, there we go. Welcome to the Main Street Money Podcast, where Wall Street meets Main Street. I'm Andrew Gate, along with Gilbert Pies and Zachary Green, and we are the Texas Hill Country Advisors based in Kerrville, Texas, here to talk to you about the markets and some of our perspective from a wealth management standpoint. So today, we're doing something a little bit different. Usually we run this as a live stream, but it's pre-recorded. But today we are actually live streaming it. So if you guys catch this on social media, Facebook, YouTube, otherwise, let us know, drop a comment. We cannot give recommendations and answer specific questions, but we can talk all day about educational topics and maybe some of our perspective with the markets or whatever wealth management topics you want us to talk about. So if you catch that, drop a comment. We should be able to pick it up and we can talk about something specific if you would like us to. Otherwise, we're just going to kind of give a rundown of what we've seen this week in markets. I think the biggest news of the week happened today, I would say, other than the geopolitical stuff that's been going on now for, I think, a full week. We had economic data that dropped this morning, mainly the jobs market data, and it was a downside surprise. So the expectation was to add about 60,000 jobs from the previous month, and we actually dropped by 92,000. So we gave up a net negative 92,000 jobs. So quite the downside surprise, but that had markets being a little extra volatile today, but the equity markets, the stock market actually sold off. And the yields, because that's the other thing that we talk a lot about on here, is the 10-year U.S. Treasury. That yield actually came down, which we would have thought it would have, but it was all over the place today. It started off down, actually went into positive territory, and then finished the day down. So if y'all want to start, maybe we can give some commentary about that and just kind of start there and then see what we come up with. So,
well, I'll say the silver lining to all of this is that if you're interested in getting into the market, you've been waiting for a downturn or correction. Now you got your time. We definitely having a little bit of a correction here. Hard to say one way or the other how long it's going to last. It may be a few more weeks. It may be a few more days. Heck, it may be a few more months. But I think ultimately what it does is the market is definitely a little cheaper than what it was a few weeks ago. And if you were concerned about getting in the market at high levels, well, now you can get in at a little lower level. Certainly won't say it's the lowest or it's got nowhere to go but up, but I do think there's some value out there to be had.
Yeah, and I think with added volatility, we've been talking about that word a lot in the back half of last year, but also the beginning of this year. Markets pretty much wiped out their year-to-date gains. So the S&P now is down year-to-date 1.7. The NASDAQ's down about 3.65. And the Dow's down about 1.82 after the closeout of this week. So we're actually in negative territory for the year. We've had 3 really strong years in the stock market. So we've had 3 years that were more than 10% plus gains in the stock market. Only 4 of those periods have occurred over the last 75 years for the S&P 500. And the 4th year out of those 4 occurrences has been a mixed bag. There's been 2 ups and 2 downs. So there's not a lot of good historical data to look at to try to analyze where we're at currently in markets, which I think just add to the existing level of uncertainty that always kind of exists in markets no matter what. But there's more uncertainty and has been more uncertainty for the last 6 to 9 months in markets.
Yeah, the uncertainty makes a market for sure.
Mm-hmm.
Zach, what do you got over there?
I don't know. I think the biggest thing for me this week was oil prices spiking quite a lot, and that's a pretty leading indicator for the economy. Everybody uses gasoline, not just for personal use, but all the big corporations do. They have to transport things, so you're going to start seeing some stocks that use a lot of transportation come down. And then even the companies that buy from companies that ship a lot, they're going to eat some of that cost as well. So if things continue to go on this route, I think we could easily see this pullback continue and get deeper and deeper into the red. and that's up to the war and how fast that can get over with.
Well, and you mentioned too that higher oil prices, that usually means a good thing for oil company stocks.
Yeah.
So if you're an investor in oil company stocks, higher oil prices isn't necessarily the worst thing in the world.
No.
Not that we want everybody to have higher oil prices in general, but that's a fine example of, even during crisis, there's opportunity, and in this case, it might be oil companies or oil stocks.
One of the other things that kind of moved around this week, really it was today, was the expectation of what interest rates, or the expectation of interest rates and where those going to be by the end of the year. So previously, up until this morning, markets were pricing in 2 rate cuts between now and the end of the year. But after that data that dropped this morning from the labor market, it looks like financial markets are now pricing in only about 1 rate cut between now and the end of the year. It's still uncertain around, that 1 rate cut actually coming through. In other words, there's a chance that we still see 2 rate cuts between now and the end of the year. However, the percentage probability assigned to that is a lot lower than the one that shows just 1 rate cut between now and the end of the year. So let's talk a little bit about bonds, because we talked about rates a good bit, and we've had some questions over the last week or so about bonds and when an investor would want to use those and kind of like what their purpose is in an overall portfolio. So one of y'all want to pick that up and run with it?
Yeah, generally speaking, bonds are considered more of a safe haven than stocks, because there's some elements to bonds that stocks don't have, namely, generally speaking, anyway, a relative assurance of a return of your principal and some interest on top of that. Now, not all bonds are created equal. They don't all do the same thing. There are all kinds of varieties of bonds. So this is just in general that I'm talking about. And generally speaking, when interest rates go down, short-term interest rates go down, the value of bonds starts to increase. And so if we have a rate cut or more rate cuts during this year, that should be a good thing for current bondholders. Those values should go up a little bit. But again, that's just speaking in generalities. They don't all do that. And there's a lot to be said for the rating of the bond. There's a lot to be said for the duration of the bond, how long to maturity you purchase. A lot of those other factors factor into it, but generally speaking, bonds are a good place to be when you're worried about safety and you're trying to be more defensive.
And one of the main reasons that it's used in portfolio allocation is because unless it's the year 2022, it's not. And even then, that was kind of a one-off where the bond market and the stock market came down at the same time. But usually the bond market is not correlated with the stock market, which is one of the reasons you own that in a diversified portfolio. Furthermore, to your point, Gilbert, bonds don't have the potential to appreciate over time like equities or stocks do, because they just represent a different rung of interest on a company's capital structure. So a lot of people don't think about it like this, but when you buy a bond, you are playing lender to that organization or that municipality. So if you think about the way fixed loans work when you go as an end user. So when I go to a bank and I take out a mortgage or an auto loan, I get a fixed interest rate and a certain amount of money that I'm borrowing to buy whatever it is, right? And then so on the bank's balance sheet, they have a fixed amount of money that represents their principal and an interest rate that's charged on top of that. And so therefore the pieces of the puzzle, if you will, are all fixed and they're all known. And so when you buy a bond as an investor, you are actually playing the role of a lender to that organization or that municipality. So you receive an interest payment only until the day that it matures, and then you get your principal back. That is totally and mechanically different than what a stock represents, because a stock represents a piece of ownership in the actual company. So if the profits of the company continue to climb one period after the next, that all things being equal, you would expect the total value of that company to increase over time. Therefore, the worth of the piece of ownership you're holding in the form of a stock should also increase over time. Now, sometimes companies pay some of their profits back to the investors in the form of dividends. So sometimes being the owner of a stock, you do get a cash flow from owning that interest in the company, but that's not every stock. Not every ownership interest in a company guarantees you a piece of the profits coming back to you or guarantees you some kind of cash flow at all, right? But the idea with a bond is that is one of the main components of it. Is when you buy a bond, you are expecting to receive interest payments back and then ultimately the principal. But all of those elements are known, which therefore it makes those markets, the bond market versus the stock market, function totally different, right? The other thing that's mechanically different or fundamentally different between the stock market and the bond market is that the stock market, stocks trade between investors on exchanges. There's multiple of those in the US, but the most notable one is the New York Stock Exchange. The bond market does not have centralized exchanges to trade bonds between investors. Most of the players in that space are what's known as broker dealers, or they're institutional type of investors that hold bonds as inventory on their books, essentially, and then facilitate those transactions in between investors. So the bond market doesn't get near the coverage or media coverage or the spotlight, if you will, that the stock market gets. And it just doesn't mechanically work the same. There are no centralized exchanges or any of that kind of stuff. But we would tell you from a wealth management perspective that bonds play a very specific role. And in most cases, in a diversified portfolio, there is some sleeve of bonds. It could be a little bit, could be a lot, just depends on the goals of that specific portfolio and ultimately the investor. But usually it has a place in a portfolio.
For sure. We've been seeing a lot of interest in bonds lately since interest rates are starting to tick down a little bit. Might be a good idea to consider as a part of your portfolio. And we would tell you that no matter who you are, everybody needs a little bit of bonds. Maybe not a huge slice if you're 25 years old, but you certainly should consider them as an option, because I can assure you, as you get older and you become more conservative, bonds play a bigger part, generally speaking, in your portfolio.
And another option that a lot of people don't consider, or even a lot of times don't even know that's out there, is if you are in a higher tax bracket, there are options for, usually we're talking about fixed income type of investments, so bonds that can pay tax-free interest to you as the investor. Now, all things being equal and comparing apples to apples, usually the interest that you expect to receive off of those types of investments is a little bit less than what you would get on a taxable bond portfolio or a taxable bond, but it is tax-free from federal taxes. And that can be a big point of interest for a lot of people that are in higher tax brackets. We have a lot of clients that did a really good job during their working years and accumulated a good bit of wealth in investable assets. And for a lot of those people, we're having conversations about that and talking to them about whether or not that fits in their portfolio and what they're doing. The other piece of that equation is that same type of bond position, like the tax-free or tax advantage bonds that are out there. Mainly, we're talking about municipal bonds and municipal bond funds. Those are also very conservative investments. They're, nothing in the investment world is guaranteed. There's no insurance. It's not backed up like deposits in an FDIC institution, insured institution, right? But there is a spectrum of aggressive to conservative type of options that are out there. When we're talking about bonds specifically, usually that's on the more conservative side of the spectrum. But even more specific than that are municipal bonds, or the tax-free type of bonds that we're talking about are even more on the more conservative side within the conservative spectrum itself. So sometimes we can look at those as options or alternatives to excess cash or liquid savings for either organizations or individuals. Sometimes that makes a lot of sense for organizations or individuals that have a lot of excess savings that they're currently sitting in the bank right now. If they were willing to come out from under the FDIC umbrella and look at some other options, although they would be conservative, that can be one that we could definitely talk about for that specific play. Zach, what you got on your sheet over there?
This is just a lot of figures from this week. What all the indexes looked like, how the bonds finished, stuff like that. You want to go through some of those?
Yeah, give us some of them.
So stock indexes for this week, S&P 500 was down about 0.75%, so not too bad. Dow Jones was down 2%. That's not great. NASDAQ was actually up 0.4% barely, so squeaked out a gain somehow. And then the Russell 2000, which covers small cap companies, was down about 3.25%.
Ouch.
So that's a butt kicking.
Yeah, and the Russell, we don't talk too much about the Russell index, but the Russell 2000 are small cap companies. A lot of those guys those companies, their stocks can be a little more volatile. A lot of them, for the most part, do not pay dividends. And that's the other thing I wanted to mention, since we were talking about that, the cash flow that comes off of stocks in the form of dividends, is there are companies out there that are publicly traded that you can own their stock as an investor, but they are literally not profitable. A lot of them, and some of them are bigger names that you would be surprised by. Like, for a long time, Amazon was not profitable. It didn't turn a profit. I mean, for years and years. And so you kind of have to, the next question would be, well, then why is there even a run up in that valuation of that business? And it's based on hope. It's based on the fact that these companies might drive big revenues, but they still are at a loss when they subtract out all their expenses, because they are spending a lot of money, and usually, in most cases, reinvesting a lot of their revenue into themselves. And so there's nothing left over. Not only there's not there is an actual loss, so there's no profits, but so there's nothing to give back to investors. They're literally showing a loss from one year to the next. But the idea is that those big revenues and that reinvestment in themselves will eventually pay off, and the expenses eventually will get to a more manageable point. And if they can grow their revenue all over that same time period, then eventually they can become profitable, and in the hopes of eventually returning some of their future profits to investors in the form of dividends. But that's not always the case. And so you'd be surprised at some of the companies that are out there and how large they are, but they're actually not profitable.
I think that's a good point for people that listen to a lot of Finfluencer content too. I'd say a majority of the stocks I get buddies texting me about, or asking, maybe even my parents or something, it will be non-profitable companies, and you just don't know that unless you actually look at the financials and do a little research. And not a lot of people know how to do that, but it's easy to look at like a Finfluencer's video, and they say,
Yes.
This is the next huge drone company coming up, and they're bleeding through millions of dollars every year still. So
yeah, not turning a profit.
No, and people just don't understand that really, and I think that's an important note you made.
Yeah, and I would deduce that even further and say a lot of that comes from the behavior of trying to get rich quickly. So a lot of influencers and people that are giving out advice on the internet that are not licensed and regulated, that's kind of what they're chasing. They're using the same tactics that these companies, like that Reels were developed by Meta, TikTok, all of that plays on the same human emotion and the human nature to try to want instant gratification. And from a financial standpoint, the idea is trying to get rich quickly. Like, there's going to be something out there that allows them to get this crazy return on their money. and it's interesting to me that so many people think that they hear something like that on the internet and they think that they found the golden ticket, and they're like, oh, this is it. Like, this is what it is. And it's unfortunate, but in reality, there are, you mentioned the thing about the stock, right? Like looking at the company's fundamentals, right? There are CFAs that sit on Wall Street, and we're talking about thousands of these people that are analysts that do this for a living. So I know that the internet has leveled the ground for the most part, and we like to think that we all have access to the same information, but the truth is that we don't, and that there's people out there that do this day in and day out for a living, and it's highly unlikely that those of us that don't live up here in the stratosphere, that live on Main Street and not Wall Street, run into something like that and find something that all these other people that do this 28/7, or 25 hours a day, 8 days a week. It's like, it's hard to think that one of us common folk runs into something and finds that those people haven't found already. I mean, it's not that likely. Yeah. But we want to believe it. And that's the other thing that's being played on in those videos and a lot of the influencer talk, is we're kind of being fed what we want to hear, right? Which is kind of dangerous from a financial standpoint.
I think it's really dangerous because you also get like the meme stock phenomenon. And like when enough people look at that, then it can push it up a little bit and it feels like you made the right choice. And then the next few weeks, you're going to see that stock more than likely peel back. But people take that meme stock pump as kind of like, oh, I found it. I figured it out. That doubles down on the bad behavior, I would put it.
Yeah. And that's the other thing that, like, we talk about people that sign big, like pro athletes that sign big contracts, or a lottery winner or something that did something, ended up with some, instant kind of get rich quick thing. It paid off for them, but it's hard to duplicate that behavior. And in most cases, they don't actually know what they did to make that happen. And in most cases, it's just luck, right? And so it's really hard to duplicate that. But what is easily duplicatable, if that's a word, is the small wins or the small behaviors that add up over time, which is kind of our game. And what we do is long-term investing. And you're taking advantage, from a long-term investing standpoint, you're taking advantage of two math mechanics that are almost more important than what you're actually investing in. So it's not necessarily about the names of the individual companies or anything like that you're investing in. You're using like a diversified portfolio, but you're taking advantage of dollar cost averaging and compounding, which are math things. There doesn't have really anything to do with individual companies or investing from into specific sectors or companies or themes or anything like that. You're literally just using math mechanics to try to build up and create wealth over the long term.
Yeah, what he said.
Yeah.
That's what I got to say about that.
Yeah.
I watched Forrest Gump last night. Sorry.
Life's like a box of chocolates. Yeah. So the other thing I wanted to add was insurance products. We've talked a lot about those because of the added volatility over the last 6 to 9 months in the markets. A lot of people don't know that insurance products can be used inside investors' portfolios for very specific reasons and means. So whether it's trying to dial down or up how aggressive or conservative a portfolio is, a lot of times insurance products, namely different types of annuities, can help achieve those goals for investors, but also planning. Some insurance products offer features that would be appealing for savers and even retirees, if we're talking about income or conservative type plays that you can't get, because in our world, when you're investing in, you can diversify a portfolio to the hilt, but there's still nothing that can actually protect you from losses. There's just not. So sometimes we look to insurance companies to offload some of that risk and look for preservation type plays inside portfolios. And the other thing I would add to that is insurance products. Some of them are extremely complex and very complicated. We all know advisors that don't touch those things because they're just too complex and they're too complicated. However, we would submit to you that they can be extremely powerful planning tools. But I think you have to keep your mind about you when you're wandering around in the wild, because there are insurance agents that hold themselves out as financial advisors, and they're just, because of what they're licensed to do, they're limited, and there's no way they can take a true holistic approach to your financial picture, and really give you holistic financial advice. More often than not, they're just salespeople, and more often than not, as well, is that a lot of those people don't know what they don't know. So a lot of times it's no fault of their own either. They've just been trained a certain way, and their knowledge base only goes so far. So I would always suggest that if you find yourself having a conversation with an insurance agent, especially if it's about some kind of whole life policy, please come talk to a financial advisor, whether it's one of us or someone else that has not just their life insurance license, but also their security licenses as well, before really making a decision there. So you can at least get more than one perspective, and maybe have a shot at getting a more holistic perspective before you make those decisions.
Yeah.
Yeah. I think that's it for today. Any guys have any parting thoughts? Anything else you want to add before we leave for the weekend?
You know, I'd like to share with the audience, if there is any audience, about our seminar coming up on March the 19th. We're doing a estate planning seminar with a local attorney, and it's going to be from 11:30 to 1 o'clock at the Kroc Center. There is pre-registration required and a small fee to attend. But if you give our office a call at 830-955-9900, we can reserve a spot for you. Lunch will be provided. So if you're interested about estate planning, or you're worried about your own estate plan, come on by. We might have some good tips and information for you to have.
We actually have a registration link that'll be on our Facebook page. So you can find that on our Facebook page and just register online as well. So once again, that's Thursday, March 19th from 11:30 a.m. to 1 p.m. at the Kerrville Kroc Center. But you do have to pre-register, and it's $20, but lunch is included. And just to reiterate, it's not just us. We are bringing an estate planning attorney to talk about different points on the topic. So we're coming from real life experience. We can tell you, we don't want to scare you, but we can tell you horror stories all day of people that did not have their stuff together, and in fact maybe thought they did, and it didn't work out the way that they thought. And sometimes that stuff can be mitigated if you just take the right steps ahead of time. But with that, we will call it a day. Thank you guys for tuning in. Don't forget, interact with us, share our content, helps other people find the show. We're on Facebook, LinkedIn, and YouTube. Thanks so much. Have a good weekend. Securities and investment advisory services offered through LPL, a registered investment advisor, member FINRA SIPC. The opinions voiced in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a decision.